This video summarizes the Bold Asset Allocation strategy, also called BAA, developed by Wouter J. Keller. It's a simple, rules-based approach that combines relative momentum for picking what to buy with fast crash protection for deciding when to step back. BAA is designed to be offensive when markets are behaving well, but to shift defensively as soon as warning signals appear. The key twist is the Canary universe, a small set of assets that act like an early warning system. If even one of them turns negative, BAA moves into defensive mode. Momentum here means trend. Relative momentum ranks assets against each other, so you can pick the strongest performers. Absolute momentum is a simple safety check. If the trend is negative, that's a risk-off signal. BAA uses both, but uses them in different places on purpose. BAA separates assets into three groups. One group is for taking risk, the offensive set. One group is for playing defense, the defensive set. And one small group acts as the trigger, the protective or canary set, which decides whether you're in offensive mode or defensive mode. Here's the heart of the strategy. BAA checks the canary assets each month. If at least one canary has negative absolute momentum, the strategy flips to the defensive universe. In the paper, this is the breadth parameter set to B equals 1, meaning the trigger is intentionally strict and fast. BAA uses two different momentum speeds. For selecting assets, both offensive and defensive, it uses a slow trend measure, SMA 12. For crash protection, it uses a fast measure called 13612W, a weighted blend of 1, 3, 6, and 12-month returns, weighted more heavily to recent moves. That's how BAA tries to react quickly when conditions deteriorate. BAA is run monthly using month-end data. Step 1, rank assets with the slow SMA 12 momentum measure. Step 2, check the canaries using the fast 13612W signal. If any canary is negative, you go defensive. Otherwise, you stay offensive. Then you buy the top-ranked assets for that mode, equally weighted, and rebalance next month, whether or not anything changed. SMA 12 momentum compares today's price to the average of recent prices. In the paper's definition, the score is today's price divided by the 12-month moving average minus 1. If the score is higher, that asset is stronger relative to others. The 13612W signal combines multiple lookbacks, 1, 3, 6, and 12 months, and gives the most weight to the most recent return. If that weighted sum turns negative, the canary is considered bad, and BAA is ready to switch to defense. The paper tests multiple versions. Two headline versions are Balanced BAA, which spreads risk by owning the top 6 offensive assets when risk on, and Aggressive BAA, which goes all in on the single strongest offensive asset. Both use the same canary protection concept and the same monthly rhythm. The difference is mainly how concentrated the offensive side becomes. To judge the strategy, the paper reports several common metrics: CAGR for growth, maximum drawdown for worst-case pain, volatility for variability, and Sharpe ratio for risk-adjusted returns. It also uses UPI, Ulcer Performance Index, which focuses more directly on drawdowns, and it reports how often the system is defensive plus turnover, which hints at trading costs and friction. Here are the headline numbers reported in the paper for the full sample from December 1970 to June 2022. Balanced BAA shows about 14.6% CAGR with roughly 8.7% max drawdown, and it's defensive in about 57% of months. Aggressive BAA reports about 21% CAGR, with a larger drawdown around 14.6%, again defensive around 57% of the time. The paper compares this to a 60-40 benchmark, reported around 9.5% return.